Hello everyone, welcome to another episode of Emkay Macro and Market Moves. Today we have with us the Chief Economist at Emkay Global, Ms. Madhvi Arora, and we're going to discuss the RBI meeting that's coming up this Friday and what the RBI could do, what are the implications of that on the economy, and essentially the policy choices that the governor and the MPC have. So first up, Madhvi, of course we have the RBI policy on Friday this week, and this is the last policy of this calendar year, the second last of the financial year. And while we've seen the RBI pause and not cut rates in the last couple of meetings, of course, it has done a lot more beyond that.
Correct.
First half of the year, of course, it had done a lot in terms of liquidity infusion, rate cuts. And since then also, even though it hasn't cut rates, there's been a significant loosening of a number of regulations as well, right? Now, coming into this policy meeting, the macro landscape is quite, I would say it's a little bit of a challenge for the RBI in terms of what it wants to do, because on one hand, you have inflation touching series lows and full year forecast going below 2%. And on the other hand, the most recent GDP data that we got last week for the second quarter shows GDP growth at over 8%. So with this conundrum in place, and of course looking at how things have evolved over the last, say, couple of months since the last policy, where do you think the RBI will stand and what do you think the decision is going to be?
Thanks, Harshal. So, let's get one thing very clear here, that for the last 1 year or so, both markets and Reserve Bank have gone absolutely wrong on growth and inflation. Just to give things in context, Reserve Bank's FY26 forecast for inflation has been revised consecutively for the last 4 times since February and is likely to get revised again in this December policy by as high as 60 bips for all you know, or even more than that. Same is the case with analysts, though we were a relatively better placed than Reserve Bank in terms of forecast, but I think the street also had overestimated inflation. As we stand today, inflation is tracking sub 2% for this year. And even for next year, where the RBI had placed around 4.5% inflation forecast for FY27, I think it would be somewhere hugging 4%. And there could be further changes to the inflation dynamics given the new index that could be coming in the month of February, both for GDP and inflation. Now, coming on the growth side again, I think we all have absolutely gone wrong on the growth dynamics. We generally have been underestimating growth, at least on statistical terms. Of course, the number this time around again was a big surprise, and 8% plus growth was nowhere anticipated by anybody in the street. We were also close to around 7.6% if I recall. That's also much lower than what turned out to be the case. As we stand today, our annual forecast for FY26 is now tracking 7.3% for the whole year as against 6.5%, which we also revised very recently last quarter. The RBI is sitting with 6.8%. So there's a good chance that RBI will have to revise it upward, above 7% at least. So we are actually in a Goldilocks situation where inflation is low, it's hugging sub 2%, much lower than the band that the Reserve Bank targets. Growth is, I think, at least again, on a statistical basis or optically is looking, 8% plus in the near term and 7% plus for the whole year. Also giving a sense that maybe potential growth is not as poor as we analysts were estimating. Now, breaking it down further into inflation and growth estimates. In fact, if you remove the noisy aspect of inflation, which is the gold inflation in the core segment, core inflation is steadily going down and it's now tracking 3.2%. Ex-gold inflation is, even much lower than 1.9% that we're looking at. So clearly there is a disinflationary impulse which is running in the economy. It could be a function of 2 factors. One is the input costs have gone much lower and thus somewhere the supply side dynamics have played a very important part. Secondly, even the food perishable inflation has played out much better than what we anticipated, which is, consecutive last 5 months, if I'm looking at the numbers where generally you see inflation noises being much higher. Food inflation, especially vegetable inflation, has actually been much better behaved. That obviously has helped in terms of supply side. Now on the demand side, as I said, the only noisy factor for core inflation, which is seen as a proxy of demand side, has been gold. And there also, if I remove the gold effect, the core inflation is tracking 3.2. There's a demand side, which is also indicating that there's a slowdown in the growth story. Now, when you look at the GDP number, it's a very different picture, which is, as you said, 8% plus kind of number. There is a lot of noise in GDP data as we stand. Of course, I'm not getting the statistical anomalies around GDP, which has been led by, the single deflator effect, or the deflator effect being more wholesale price driven, both for manufacturing and services value add, which has overestimated the growth story, and will next year, when the WPI inflation goes up, will actually underestimate GDP growth. But beyond that, also, if you look at the non-statistical aspect of growth, there's been a noise with regard to the GST-led delays in spend, which will probably look optically much better in the October to December quarter, where the consumption effect will be much better felt. So I think there is a lot of noise in the GDP numbers, but if you remove the noise and look at the nominal picture of the growth, which is deprived of the deflator effect, you'll actually see nominal growth is actually tracking sub 8% for a long period now, and for the whole year also it will be just about hugging 8 or even lower than that. And all our macro and market variables are actually, pegged to the nominal GDP. So all of them will have to be calibrated, whether it's fiscal deficit, debt to GDP ratio, current account, corporate earnings, corporate debt. All of that will be, will have to be keeping in account the fact that the nominal growth is actually much lower. If you look at companies' sales growth in the last quarter, they have been actually moderating consecutively for the last 6 quarters or so, and I think you may see some improvement in the second half of the year, but it's not looking to be a V-shaped story, and there's a lot of noise in the data with regard to how much consumption uptake has actually happened. But we reckon the fact that there's been an improvement in the consumption dynamics in the private sector, both from urban and rural sector. We'll see how well it sustains, but definitely it's not a story of an 8% for GDP growth at this point in time.
So with that in mind, as you said, of course, underlying dynamics for GDP growth are, they're not showing the true picture, or essentially the nominal numbers or the headline numbers are a little bit overinflated, so to speak. But inflation is, of course, far lower, and again, even if you strip out some of the volatile components, as you said, as you're removing gold and so on, it is still far lower than what we have thought, all of us had thought at the start of the year, or even say 2 or 3 months ago.
Correct.
So don't you think that given that the RBI is, legally or however it's phrased, the RBI is at the end of the day an inflation targeting central bank. So with those dynamics in mind, don't you think a cut is warranted?
So we have been arguing the same thing, that central bank's primary mandate is actually inflation targeting and not growth targeting or labor market targeting, unlike the Fed. Interestingly, the Reserve Bank has been focusing a lot on 1 year ahead inflation. They've been saying that while recent dynamics have been softening for inflation, 1 year ahead inflation is looking above 4%, and thus we need to focus on what will happen a year ahead from now. Clearly, the way inflation has played out, it's basically a joke to even look at 1 year ahead inflation, because we really don't have a handle of what will happen next month, let alone the 12-month ahead numbers. And if you have to take that in consideration, then technically speaking, the growth will see a unfavorable base effect next year, and growth will be lower. So how do you play that card if you really have to play both ways? In fact, the Reserve Bank also has acknowledged that there is some weakness in growth impulses. Of course, it's in patches, not across the board. If consumption is doing well, still there are variables like exports and investment which are not doing as good as they would have liked it to do. And they have expressed their intent to actually cut rate. The timing is a big question mark. Possibly, they are looking at the ongoing discussions between India and US as to how the contour of the trade deal could turn out to be, which could change the shape of the growth story ahead, and that could probably lead them to delay maybe a final rate cut, if at all. But I think there is space for one more rate cut. We are going in with a cut in this policy with a understanding that there could be a split in the MPC. There could be a 4-2 split, or it could be even a close call with a veto by the governor, if at all. But it's going to be a very, very close call with regard to rate cut. The timing is debatable, but if not this time around, then February could be the case. I think they are waiting for certain noises to play out in a more clear fashion for them to take a more stable call. But I think it could still possibly be a cut in this policy with a split in terms of MPC members' vote.
Right. So now, another extremely important aspect of the monetary policy sort of paradigm, especially this year, has been liquidity, where
Correct.
start of the year, due to certain previous actions that were taken about essentially exactly a year ago, liquidity was extremely tight. The new governor who had just about taken office around this time last year came in and sort of unleashed a bazooka of liquidity infusion measures through bond purchases, FX swaps, and so on. And that sort of stabilized the regime. And since then, we've been largely comfortable, other than some seasonal frictional sort of dips in liquidity here and there. But we still note that, transmission of rates has stalled to an extent because banks are struggling for deposits. CD ratios are above 80%. If you look at 12-month trailing CD ratio, it's above 90%. So banks are clearly struggling to mobilize deposits, and that is leading to certain segments actually seeing deposit rates go up, which is obviously not what the RBI wants in a easing cycle, which is still where we are currently. And we've also seen that, liquidity may not be enough, which essentially indicates that liquidity right now may not be enough to offer the full transmission that the RBI wants. So the second thing to look at then, therefore, from the market's point of view is probably going to be, one, of course, is the rate cut, which we've discussed, but secondly, what measures are needed for them to sort of improve the liquidity situation first of all, is that required at all at present or not?
So, as you rightly said, the liquidity, trends have played out favorably in the first half of the year, led by what the Reserve Bank did with regard to expanding its balance sheet. Unfortunately, consistent FPI outflows from India, partly on account of failure to secure a deal with the US, has costed us in terms of FX, right? Policymakers have been intervening both in spot and forward market. To a large extent is unsterilized, which essentially has implied that whatever expansion in the RBI's balance sheet had happened because of purchases of open market government papers has been largely now offset by the FX intervention that they have done. And also whatever they had done in terms of their past intervention in the forward market, for which they were receiving deliveries or taking deliveries of the forwards, they also have a lot of stalled that, and actually the net short book has further built up in their RBI's forward space. So to a large extent, the recent tightening in liquidity has been on account of the RBI's unsterilized intervention. Of course, other factors like currency in circulation, relatively delayed government spending, all of that had played out. But I think the biggest variable has been FX intervention, much more than what we had anticipated. Beginning of the year, when the RBI was going all out with open market operations, we argued that they are softly targeting a 1% of NDTL kind of liquidity on an average for the year to keep transmission healthy. They may still be running short of that 1%, and they would require probably another 2.5 lakh crore kind of additional liquidity from June to today. I think to a large extent that has come out to be the case. If at all they intend to achieve a 1% of NDTL kind of liquidity by end of the year, our current estimates suggest that they will have to do almost 2 lakh crore of open market operation. Additionally, just to note, in the first quarter of this financial year, they had done close to 2.6 lakh crore kind of OMOs. In the last 3 months, last 2 months specifically, they have been, purchasing secondary market to the tune of around 300 billion roughly. So I think there's still more space for them to do another leg of OMOs, which could possibly happen between December to January or to March. For them to achieve the current liquidity scenario in the same by the end of the year. In case they do not end up expanding their balance sheet to the extent that we are expecting them to, the liquidity deficit could be, surplus could be as low as 0.3% of NDTL, which is not what policymakers would like for the better transmission. Of course, we are also assuming that the FX intervention will continue because till the time India doesn't secure a deal with the US, there will be pressure on the currency. We're seeing that happening today as well. In the last week also, we saw the same play out. And India would be unfavorably placed in terms of FPI flows, in terms of the risk premium that it has to offer. So I think it's a tricky situation, but From the liquidity point of view, I think it's important that the policymakers, expand the balance sheet further, increase the reserve money to the extent that whatever transmission that was playing out in the last 6-9 months continues as you go ahead. Interestingly, if you look at the past cycles of rate cuts, historically, all the rate cut cycles have actually had more than 2% of NDTL kind of liquidity by the end of this cycle. So, what we're asking for is not much, it's just about adequate. I think there could be even scope for more, if at all. But we'll see how that plays out. I think transmission becomes a much more important compared to a rate cut in terms of better transmission to the bond market, to the rest of the economy. If you look at the current bond market, it is extremely steep, extremely unhealthy. The kind of spreads that one is seeing between 10-year and 30-year, 10-year, 40-year, even between 5 and 10-year is much higher than what you would like in a rate easing cycle. So I think that's a need of a hour. More than the rate cut, I think liquidity is a bigger variable for us to watch out for. And of course, as you mentioned in the early part of this discussion, that regulatory easing is something that may continue, if not in this policy. In February policy, you may see more measures coming, which could ease the banking sector and non-banking sectors financial conditions in general. Something that they have been anyway doing in the last 1 year or so.
So lastly, just to touch upon something you mentioned already, which is the currency. Now, that's obviously something that's extremely visible to everybody, and last couple of weeks have seen sort of the rupee break the 88 barrier, which it, the 89 barrier rather, which the RBI was sort of stoutly defending. It's now gone away from doing that. Even today, as you said, the rupee has seen a sharp depreciation. We're now at about 89.5 or so, may even touch 90 for all you know in the next few days. So given that all of this has happened, so in the run up to the policy, so close to the policy meeting, do you think that this at all could be a deterrent to the RBI cutting rates on Friday?
I don't think so. I don't think that rupee should be a variable at this point in time. I mean, I understand policymakers have the traditional trilemma with regard to whether they should manage domestic dynamics or the external dynamics and how to play the interest differential and all of that. But honestly speaking, at this point in time, a weaker rupee is the need of the hour, right? You have been disproportionately hit by penalty tariff by the US. You are much worse placed compared to your peers on trade competitiveness. Rupee should be the natural variable or natural adjustment factor for a weaker export growth. So I think it's a need of the hour. Policymakers should let the rupee be. We've been arguing that, I think, for the longest period, that rupee should find its own equilibrium, especially in time when there's structural changes that are happening in the world order. I think policymakers also understand that, both from the fiscal and monetary side, that there is no need to defend a currency which probably needs a further adjustment. Of course, they wouldn't want it to have a massive bump down or bump up, because that volatility is not something that is liked by the policymakers. But I think directionally, just because textbook says that a reduced interest differential between two economies leads to a weaker currency, it doesn't really play out in India. Sometimes, in fact, the rupee is so agnostic to the policy that it doesn't even move on the policy day, even on a rate cut. And India is more a growth-seeking flows economy than interest differential-seeking or debt-seeking economy, debt-flow-seeking economy. So I don't think that should be a deterrent. Actually, it should be a variable that they should just, at this point in time, let go of in terms of managing the reaction function, and only manage to smoothen the volatility, which is what they are doing, I think. So I don't think they would have any number in mind to take care of per se. Of course, they understand that markets don't like shocks, and they would take care of it, but I don't think they're directionally trying to save the rupee and would not cut because of the rupee. They may choose to not cut because of other factors that we discussed, but I think INR would not be the prime variable here.
Right. So thank you for watching. This was another edition of Emkay Macro and Market Moves. Stay tuned and we'll be back with more. Thank you.